And so sub two is this sexy thing, but when people understand the risk, if you're not capitalized or prepared to handle the risk, what happens if the bank accelerates the loan? Well, you should have a plan in place. That's risk management, thinking ahead and thinking through the solutions. Sometimes you have to sell the asset to be able to pay off the loan. Sometimes you can fix it up and sell it for a profit. Sometimes it's break even. Sometimes you have to refinance it. Those are all worst case scenarios to me, though. Often we can rescue the deal, restructure it with paperwork, make the bank happy enough that they leave us alone. But that's custom to every situation.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Caleb Christopher. Caleb is the founder of Creative TC, DOSGuard, and Creative Title Company. He's a cybersecurity expert specializing in creative finance, risk management, and ethical business building. And in just a minute, we're going to speak with Caleb about creative finance mechanics. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Caleb Christopher. Welcome to CREPN Radio.
Thank you for having me on.
Well, I'm delighted you're here, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I spent a couple of years in prison as a worker. So I have some physical security experience where I read and updated policies and procedures. I was a guard, but I'm a nerd too, so we weren't allowed to bring in outside reading materials. So guess what I read? Security manuals and policies and procedures. And so I found that I have a liking for weird stuff like reading laws. And so I learned physical security, policies and procedures, risk management there. And then I shifted to IT and upgraded to cybersecurity. So got a degree in cybersecurity and risk management. And so risk management physically and digitally. And I just have this risk thought mindset. And then I read Rich Dad Poor Dad, and what can you do except take action after reading that? My goodness. And so I got a rental property, started getting into real estate, bigger pockets, found some creative finance resources, and started buying and selling real estate that way. And I saw some gaps, and I opened a company to serve and consult on the creative finance area, which is buying and selling, in my world, that is buying and selling subject to an existing loan, which is a pretty complex relationship between the parties. And so I dove into that, the legality, the ethics. And so my company was focused on making creative finance real estate safe, legal, and ethical.
I love it. I love it. I'm curious on your view on the cybersecurity. I guess the state of things. I feel like I spend half my day putting in passwords and verifying who I am. Do you have any sense of, is that going to change, or is that going to be just kind of the way it is?
Other than one of my cameras on my computer has the face scanning technology like Face ID. I mean, incorporate that into computers and do biometric authentication. That's going to be faster. But no, I think the multiple factor is all you can do as a
Yeah.
baseline.
Well, I just know that for all the upside of computers and stuff, the downside seems to be limitless as far as, and I say limitless. I mean, just we're exposed. Now that we're all
Yeah.
connected, it's easy to for the bad guys who want to figure out a hole that the guys that designed it didn't see or didn't understand that they created, kind of thing. And
I,
and
I
oh, go
think
ahead.
that's the cost of convenience. That's
Yeah.
that's just the way convenience works. It's a trade-off between risk and convenience. In fact, I was having staff reviews today, and one of the people that I sincerely appreciate at the title company I own, we were talking about, I said, I want to get on the same page. There is too much to do, right? I'm not expecting you to get everything done. And I don't want you to have the mindset that you're overloaded, that there's too much to do. The way business works is we do what we understand, prioritize, execute. And you execute what you can while you can. And what's left is risk. That's literally all it is. And we either accept it or we don't. But I don't want you to get burnt out because there's too much to do, because there is too much to do, and we just accept that. The rest is risk. That's business.
No, I love that. I love that. That's a pretty healthy perspective on just because it literally you can stay looking at the screen all day, all night. It'll keep feeding you more to do.
And you can
Uh,
worry as much as you want,
yeah,
but
yeah,
uh, you got to operate. And if you get taken out by something unpredictable or that you couldn't control for, that's
yeah,
life.
yeah. No, well put. Well put. Well, let's talk a little bit about creative finance. Um, when you think of creative finance, do you have some kind of go-tos, or are you a kind of a blank slate? Let's see what we got figured out, or what are your thoughts on, or kind of the range of creative finance that you've done?
Creative should be a solution to a problem. I don't think you should never be starting with creative. Go back to single family real estate. If a cash offer works, do that. One and done. Here's your cash, give me the asset. I don't need to know you or or in a relationship with you long term. Simplest, smoothest, do what's best that way. But if that doesn't work and keeping it and renting it out doesn't work and the realtor or MLS or it can't sell for some reason, let's have a discussion. What are the other options? What are your needs? What are my capabilities? And vice versa. And let's build a solution. So most of those solutions fall into normalized buckets. We've been able to normalize or categorize the types of deals that we do in creative finance, but it does need to be based on there's a story between these people and it's a solution to a problem. Categorically, those things fall into some sort of seller finance, sub two, so leaving your loan in place, your loan and your credit stay in place while I buy it and take over the asset and make the payments for you. But again, that's a complex relationship, so it's not your go-to. So we've got seller finance, we've got sub two, there's a lease with an option to purchase, there's a contract for deed. Most of these are like subsets or more specific versions of a seller finance arrangement.
Got it. So I'm assuming when you speak of seller financing, the seller has no lien. There's no mortgage in place. It's more they own it free and clear, and that gives them the ability to be the bank if they so choose. Is that
Yeah, that's what most people are thinking, and I'm not going to combat that. At the highest level, yes, but subcategorically, if you have $1 million asset with $200,000 worth of equity, and I can take over payments, we would call that a sub two because I'm taking over the $800,000 worth of debt. But what about your equity? Is it all cash up front? Yeah, then we're just a sub two. But if I give you 50,000 up front and you finance the rest, we've combined sub two and seller finance. So seller finance doesn't always mean a free and clear asset.
got it? Got it. And when you do the subject to, um, let's talk a little bit about some of the mechanics of that specifically. I know there are people that run into it. I'll say willy-nilly, like, "Oh, yeah, that's great," and then there are others that will get kind of bogged down in the mortgage fine print and get all concerned. Can you kind of walk us through the ins and outs of subject to?
Yeah, so my first company is Creative TC, and that's a consulting firm. Again, that was created to make these deals safe, legal, and ethical, which means you need people who understand what they're getting into because it's pretty easy to do one of these deals, either intentionally or unintentionally taking advantage of somebody or doing somebody dirty, right? So everybody needs to be educated and make an informed decision. And that's what we were existing to do is, hey, Mr. Seller, did you recognize that this loan stays open and that your credit stays on the line? So if the buyer doesn't make payments, that hurts your credit, not theirs. Are you okay with that? Do you understand that? Is there a reasonable trade-off as to why you would do this deal, leaving your credit on the line? Well, a lot of people in the single family world are avoiding foreclosure. Hey, I don't want a foreclosure on my record. These guys will give me money to move and get a new apartment, and they'll take over payments. So it makes sense from the seller's perspective to do that. As long as they've got a reason and they understand what the deal is, why they're doing it, and they've made that risk decision, we're good, right? That's what we exist to do is we bring that consulting, we bring project management to that deal so that the buyer has a lot of new responsibilities and technical things that you can learn by mistakes or you can pay to learn from somebody else's experience. And so that's what we exist to bring into that picture.
So in that, can you speak to some of the fine print in the mortgage with respects to is there a risk that the bank could call the note?
Absolutely, there is.
Okay.
So this is the big scary one. I think of shark attacks, by the way, when I think of the due on sale clause, and it's in every mortgage. I mean, a seller finance note or mortgage might specifically not have it if you specifically ask not for it. But the due on sale clause allows a bank to say, you sold or transferred the property. I didn't approve that. So I don't want to be, my name's Bennett and I ain't in it. Pay me off and let's be done with this. You have 35 days to pay me off, or else we're going to initiate foreclosure proceedings. And so they can foreclose. They can foreclose not because you transferred it without their permission, but because they accelerated the loan and you didn't pay them. So it's in every mortgage clause, or every mortgage. It's usually clause like either 16 through 19. One of those is usually it. And that's, it is what it is. You can't avoid it. You can't do a sub two deal and like cancel out the due on sale clause. So it is a present risk in every single deal. I've seen it happen. I've fixed it. I can't guarantee it won't happen. I can't guarantee I can fix it. So if the heat's too hot, you got to stay out of the kitchen. And so sub two is this sexy thing. But when people understand the risk, if you're not capitalized or prepared to handle the risk, what happens if the bank accelerates the loan? Well, you should have a plan in place. That's risk management, thinking ahead and thinking through the solutions. Sometimes you have to sell the asset to be able to pay off the loan. Sometimes you can fix it up and sell it for a profit. Sometimes it's break even. Sometimes you have to refinance it. Those are all worst case scenarios to me, though. Often we can rescue the deal, restructure it with paperwork, make the bank happy enough that they leave us alone. But that's custom to every situation.
So that really is kind of the sum of the due on sale clauses. It's more of an acceleration of the loan in that because of the sale that occurred, the loan's due.
That's
And
right.
so it's not a matter of I like the way you summarize that because I think sometimes it's easy to get bogged down in the what if and not understand the what if and also your alternatives on what you can do to you know, move on or you know, plan B. And that's really concrete. I like the way you put that together.
Yes, it's good to buy with some equity so that you can either afford to refinance with low or no money out of pocket. But if you're low equity, you could have to come out of pocket quite a bit of cash to be able to save the asset through a refinance. And so usually a deal restructure is something we can do. But the another angle is, well, what if they're accelerating and I can just add, I can do some quick rehab and sell it. All right, well, talk to the bank. Talk to them and say, hey, my plan is to resell this in the next 6 months. I have a construction loan. We're starting work on the property. Sorry you don't like it. Do you want to initiate foreclosure proceedings? Because we're going to have it sold by the time you can even get any progress there. And play a little game of chicken, basically. But the thing is, you can't play chicken with somebody else's credit.
Right.
And so you've got this notice, a due on sale notice in the mail. Uh, Go change your underwear real quick, and then let's take a moment and look at it. You've got 35 days approximately, usually 35 days to handle this, get it paid off, or help them understand that it's not actually true that you transferred the property, but you can't be lying to a bank. So you have that time frame, but beyond that time frame, it starts damaging the seller's credit because now you're late. Now the payment is late. Instead of the normal monthly payment of, $2,500, the monthly payment this time is the final, and it's $497,000. Pay us off. If you're late, you're late, and it hurts the seller's credit. So you
Oh,
have to deal with it.
that's pretty concise and pretty clear because I think even the whole foreclosure, um, is more of a process. I
Yeah,
think for a long time I kind of uh, or did not understand fully what that meant until you get into it. You realize, oh, this is a process. It's not like just hey, we're foreclosing, hand over the keys, get out of here. That's not the way it works. I mean, there's usually and I don't even what's a typical timeline on a foreclosure. I guess it depends on where you're at, but what?
it very heavily dependent upon the state. I mean, New
Yeah,
York and California, you can expect 12 plus months. Sometimes, if you know how to play the game, you can stretch it out to years. And some people have figured out that they can just live rent free, basically. They're sacrificing their credit, but they can live rent free for like a year plus in certain states. In Texas, yeah, you're looking at like as little as 21 days.
you're out. Yeah,
Yeah.
that's well, and I guess from an investor standpoint, that would be a more attract. I mean, from a standpoint, if you're an investor and you have a rental, and you're a private lender, that'd be
Hmm.
an attractive strategy
Absolutely.
or a place to invest.
So when you're buying and selling notes, you want to look at the laws of the state in which that thing is located. And I mean, if you buy non-performing notes in states that have fast foreclosure timelines, you can prioritize and execute.
Yeah, yeah. So the the list of, or I guess the menu of options in creative finance. We talked about the seller, subject to. You mentioned lease,
Lease
and
with option to purchase.
yeah, let's talk about that one. What's a lease with option purchase look like?
So a lot of times an investor will get control over the asset and you get to test the market. So when you sign a lease, now I'm not an attorney. I just read a lot and people ask me why I'm not, but I don't want those. I like not having certifications or licenses. It lets me say what I want to say without anybody being like, hey, you can't say that. Yes, I can. It's my opinion. So in a lease with an option, it's one of the ways you can gain control and test the asset without having to put a full down payment. When you sign a lease, though, I want you guys to know that you're basically accountable. Well, not basically, you're accountable for the full value of the lease, not just the monthly payments until you decide to cancel. So keep that in mind. But if I can rent a property for $2,000 a month from someone and I think I can rent it to a renter for more, then I can get this lease. It would be more of a master lease, right? And that gives me the opportunity to only come out of pocket for any month that it's not occupied. But if I like the market, if I like the house, that's a good way to test it out. And if I have the option to purchase, then I can go get a loan based on the performance of the asset. It's also a great way to operate an Airbnb. Of course, you need permission to do that out of somebody's long-term rental. If they have a long-term rental in a market you think an Airbnb would do great, you can rent it, furnish it, and rent it out Airbnb and test that out. But you don't have the long term commitment of a 30-year loan. And the option to purchase gives you control over the asset because they can't sell it out from under you, or your option is actually locked in.
Yeah, that's kind of a neat way to look at it. I mean, especially
Mhm.
like you said, when you're wanting to test a market and kind of get to know um, the real what's really going on in a marketplace. I mean, because I think
Mhm.
that especially with the internet and Zoom and Zillow and all these tools we have available to us, it's real easy to be wowed in a particular market, and maybe you're comparing it to where you are as opposed to the reality of on the street, in the neighborhood kind of thing. And so that's a great idea.
And on top of that, there's a sandwich lease option, which is a little bit more creative, actually, quite a bit more creative. It's when you sandwich two lease options together. If I, as an investor, can negotiate a lease with an option to purchase, I legally have the option to purchase that property. Well, if I can then turn around and put a renter in, I can sell them a downstream option to purchase. A renter with an option to purchase is typically a better renter for performance, for payments, and things like that because they jeopardize the fee that they paid you for the option to purchase. Let's look at my first rental property. It's right next to an elementary school. Like you can see from the front porch, your kids walk to the entrance of the school. That's pretty valuable for a family who only has one car and three young school kids. So would they pay out of pocket extra money on top? Hey, I'll pay your market rent $2,000 a month, but I would also pay you $10,000 or $15,000 up front to reserve the property for the next 3 years. You can't sell it to anybody else because I want the option to buy it. For that family, that's a value proposition. Yeah, I'll take your $15,000 and then you have the option to buy this house for 3 years. But if you default on the lease, your option expires. You have some pretty good performance incentives for these people to always pay rent and go fix their credit profile and buy the house. Their option can be for a profit. The sale price can be for a profit for me. So again, if I acquire low and negotiate a contract for high, if they execute, I make money. If they don't execute, I can do it again with the next buyer, collect an option fee and set a price. It's a pretty sweet deal, and you don't even have to own real estate to do it.
Yeah, no, I should say the limits of the opportunity are kind of what you put on yourself. I mean, if you understand all the way the rules are and what the options are, and you have a willing seller. I think the thing that you started this conversation by saying these are solutions to a problem, and I think the key to it is identifying the problem and understanding the solution that you can implement and create a win for you and also for the seller, in as much as that they're willing to go forward with you. I'm curious in the current economic cycle we're in. We are recording this in February 26. Mortgage rates have crept up from where they were, during the COVID low rates that we had.
Mm-hmm.
There's been talk of them kind of coming back down, but I'm curious, where do you see the cycle of opportunity and I guess in relation to historically there've been like these ebbs and flows of opportunity. Do you see just kind of a steady stream of opportunity, or are you seeing any kind of or are you prepared for any kind of a spike of opportunity, or
In creative finance,
yeah,
if interest rates go down, I think there's going to be a lot of refinances because Americans live on credit cards or they are ready to buy a boat or something like that. So if they can pull cash out of their house, they will. But a drop in interest rates is also going to raise prices, which is going to force a ton of equity, if you want to call it equity. Call it what you want, but what the market's willing to pay has gone up because money got cheap again. So now you've got a bunch of people with even more equity sitting on it. And if interest rates are low, they'll cash that equity out or be willing to move. And so I think a lot of transactions are going to start to happen, but you'll have a bunch of fresh low interest loans with low or no equity again. That's pretty attractive to investors. And when those loans go into default, which they often do, you've got these people waiting to say, hey, you're in pre-foreclosure. Let me save you. I'll take over your payments. So yeah, there's going to be some pretty sweet deals that come 6 to 12 months after interest rate drop.
No, that's again trying to understand the cycles and where the opportunities are. That's good. I know some of the people I've listened to and kind of spoken with have kind of indicated that until interest rates drop, there's not a lot of motivation for people that have a low interest rate to move or or refi or whatever because they've got a really good low interest rate. But like you said, if people have leveraged their home to buy boats or toys or whatever it is, and need to I mean, there is a big cycle of the refi thing that drives the economy. That would tend to make more sense. When you get into a creative finance situation, do you have any kind of target parameters that you're looking for? Is there a percentage equity that you like to make certain you're getting, or is it just a matter of do the numbers work?
It's mostly do the numbers work. That's the primary thing. You shouldn't be upside down. Before I forget, remind me to tell you what you can do if you're sitting on a low interest loan on a property you do want to make a move or something like that. And we'll come back to that. The what matters is does the deal work? I've got a deal with a 3.625% interest rate. I walked into it for no cash because the sellers had a second home. They were making payments on two homes. They thought they could sell this one. It didn't sell. I was the final person they talked to after like 8 months of trying. Wholesalers couldn't sell it. Buyers didn't want it. Investors didn't want it because the rent rates don't pencil out. I said the same thing and I told the sellers, you're not going to believe this. I told the sellers, here's my spreadsheet. The reason nobody's buying is because it's negative $200 a month cash flow. It's not going to sell. And you know that. I'm not trying to beat you over the head with that, you guys. But I said, here's what I can do. I like the interest rate. It's not a today deal, but it's a 5 years from now deal. So 5 years from now, it makes sense. Right now, it doesn't. If you make up the difference, you're already making the full payment now, and you can't afford to let this go to damage your credit. So make up the loss to me, and I'll take it over and operate it as a rental. If it's not tenanted, I will pay the full mortgage. Here's my credit score. I'm going to commit to do that because I believe in this deal 5 years from now. Today, not great, but I like the interest rate. And they were like, that's a lot. We have to pay you to buy our house. Yep. And your credit's on the line if I don't make payment. I'm not going to pull any punches here. The truth of the reality of the situation is you're in a tough spot. I can help you, but I'm not in a position to just lose money on the deal for a few years. So if you make up the difference for 2 years, I'll take over the asset and I'll make sure it gets paid without fail. 2 days later, guess what they called me and said?
Let's do it.
Let's do the deal.
No, I love it. I love that. Just the ability to be creative and think outside the box is really where the deals are made. I
Yeah.
know.
It's after property management, I'm losing right now. This is 2 years into the deal, 2.5. I'm still losing $37 a month after like this is gross cash flow, not accounting for repairs and maintenance, right? And CapEx. So I'm not setting aside savings. I'm literal actual negative $37 a month on this property after property management fees. And I'm okay with that.
When
It's
does
building
the
equity.
yeah, when does the lease renew?
I don't know the annual cycle on that particular lease, but it's it's more about keeping it occupied, steady, and paying down the debt and holding on to
Yeah.
this 3.625% interest rate. And like I said, it's a 5 year deal, not a 2 year deal. And so we're halfway through that cycle. It'll start producing a little bit of cash flow, but I walked in with no money out of pocket. I made some repairs to the property with an insurance check that they assigned over to me. So literally no money out of pocket. And I sat on it empty for several months. So there's the out of pocket money. I had to make several months worth of payments. And I did. And I will honor my word to these people and make sure it gets paid, even if it hurts me.
No, I love it. I know the first deal I ever did was not in those terms, but it just kind of understanding where the seller was and making an offer that made sense to me and getting agreement and being able to move forward because it was nothing that a realtor would have brought. The realtor looks at it, here's the price, here's the lender, go talk to the lender if you qualify, make that work. But when you go off script and you're able to kind of make it up and kind of find where a buyer and a seller can meet, it's kind of the Wild West. I mean, whatever the limits, whatever you're willing to do and the seller's willing to do is where you can make the deal happen. That's
Right.
that's cool.
It's just a giant whiteboard. Put your
Yeah.
deal on the whiteboard. Draw out what you want to do. But that's also the importance of having a consultant who's been there and done that and seen stuff that failed and understands risks and talks you through that. So that's what I created that first company for. Can I?
I wanted to ask you about the low interest loan
Yeah.
option you mentioned.
So if you're sitting on a low interest loan, I'd say sub 5%, ideally below 4. But if you're sitting on one of those and you don't want to refinance, it makes sense to me. It makes sense. What I've seen some people do, especially if you also want to move, but you don't want to let go of this rate, never let go of a low rate. You can rent a property out, but you can also sell it and mark up the interest rate. That's a form of seller finance. Hey, I've got a 3.625% interest rate on this house I bought in Colorado. If you want to be my buyer, current interest rates are 6 or 7%. I'll give you 6 or 7% interest rate. You buy the house at a decent price from me, I'll provide, it's called wraparound financing. I still owe the bank 3.625% interest. So when you pay me, the monthly payment includes the regular monthly payment plus the interest, but anything on top of that is mine to keep. And so if I've got a $400,000 asset and I mark it up by, let's say, 3.5%, that is going to be almost 175 times 4. The head math kills me when I'm live.
Yeah.
I can make anywhere from $500 to $900 of markup on interest per month with that. And so then it's not a rental property though. I don't have to go fix the toilet. That's pretty attractive. If you sell the house on wraparound financing, that's one way you can mark up your interest rate to somebody else, give them an opportunity at market rates, and you can make money because you already have a low interest loan.
Yeah, no, exactly. I love the again the the ability to think outside the box and make something work because there's the buyers are they're out there, but they're also like if they have any kind of historical memory of low interest rates and they're waiting for low interest rates kind of thing are kind of on the sidelines. And I think that's where a lot of people get kind of stuck. And like you said earlier, I know that prices go way up when the interest rates come down because basically if you're a payment buyer, the payment. It's just a matter of what the interest rate does to the math on the back end and what that looks like as far as how much you can buy.
Yeah.
And so that's awesome. Um, let's see. I was thinking. I thought there was something else I wanted to ask you on the creative finance. Um, we've kind of gone through the mechanics. I'm curious. Do you have any commercial real estate, commercial finance stories you can share, or any kind of things you've done?
Yeah, it's still mostly real estate related, but there was a business. It was a tiny home park and a few other assets, but the tiny home park had an SBA loan on it. And we helped a buyer structure a deal where they were going to be able to take over the asset and the property. There were two separate things, or the business and the property and another piece of real estate all in one big deal. And SBA has its own due on sale like any loan does. And so what we structured was a contract for deed, which there's so many we don't have time to dive into it, but the deed doesn't legally transfer on public record with a contract for deed. But depending upon what state and county you're in, it may still be very visible on public record. So the visibility depends on how they treat it internally at that county. So we structured that. The alternative was to buy out the interest in the LLC, which is a non-public transaction. Still a violation of the clause, but I think another important point here is civil versus criminal issues. We're dealing with a contract violation, a default on a contract. It's not a criminal issue to default on a contract. It's a civil. And the other part is the contract already speaks to, if you do this thing, we can do that thing. So we're not even exiting the contract on how this issue is addressed or resolved. If I transfer the property or the beneficial interest of my entity to somebody else without the lender's permission, if they notice, if they care, they can accelerate the loan. That's it. If I don't pay the loan, they can foreclose. That was already true. So it's not like they have to come sue me for anything or pursue me or accuse me of criminal charges. This is contract violations are a routine thing, and you violate a contract when you deem it's worth it to do it.
No, and again, I think understanding that it's civil versus criminal, and just kind of just understanding the guardrails of the contract. I mean, they're designed, or they're put in place so that there's an exit. The exit is known for both parties.
And I promise the mortgage companies have more experience than you or me or anyone and their mom when it comes to handling defaults on these contracts. So if they
Right.
notice and if they care, plenty of times they don't. Sometimes they do. If they notice, if they
Right.
care, they can accelerate with the due on sale clause.
Right. No, that's all. I mean, eyes wide open. That's what you want when you go into a contract or any kind of a deal, is to know exactly what the risks are, and what your plan B is, and that's good. Hey, Caleb, if we could, I'd like to shift gears here for a second. As I mentioned to you before, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. The first is we look to see if we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be the interest rates, could be the political climate, could be local government, could be whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Caleb Christopher, what is the biggest risk?
I'm going to answer with a categorical answer. I think the biggest risk is any risk that you either refuse or fail to identify and seek to address, like you talked about. What bucket can I put it in? Can I transfer it? Or do I have to accept it? But the ones where you don't have the eyes wide open, the ones that catch you unawares, are the biggest risks. So I think the biggest risk comes from a reluctance to engage either JV partners or consultants or attorneys or any general education, leaving yourself open to be blindsided by something you didn't see coming.
That is very well said. Eyes wide open, and make sure you understand the risk. That's good. Caleb, where can the listeners go if they'd like to learn more or connect with you?
Everything is going to be at calebchristopher.io. I've got links to my businesses, how to work with those, get in free contact. If you're considering a creative finance transaction, I have free 15-minute consults. Remember, my mission is to make deals safe, legal, and ethical. And so we have free 15-minute consults because I want to be a lighthouse warning people away from the rocks. And if it costs me money to do that operationally, I'm happy to do that because it's what the industry needs. So calebchristopher.io, I have a newsletter there. I occasionally post investment opportunities with me, but you can also engage with my companies from there.
Awesome. Well, Caleb Christopher, I can't say thanks enough for taking the time to talk today. I've thoroughly enjoyed it and learned a lot, and look forward to doing it again soon.
Thank you. It's an honor.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.